In this video, I'm just going to be summarising basically some of the key facts from those plain English economics articles. So you should have read one for January, February and March. I'm just going to go through some of the key points that are made in each article, sort of condensing 12 pages into 3 slides basically. So, January 2016. Okay, well, some of the big things that are going on. Commodity prices are continuing to fall. And because commodity prices are falling, basically companies that are selling commodities aren't getting as much money. So basically they're selling very similar quantity, but rather than selling them for $150 a tonne, they're selling them for $50 a tonne. So they're getting a third of the revenue. And because they're not making as much money, they're not paying as much company tax. So the government's collecting a lot less in company tax from these companies like BHP and Rio Tinto, and therefore that's increasing the size of the budget deficit. They're not collecting enough revenue to meet their expenditures. So the government's not collecting as much company tax from export-related industries, and remembering that companies pay about 30% in tax when they make profits. And also these miners aren't making as much money. We're not seeing engineers and miners earning $250,000, $300,000 a year anymore, and therefore they're spending less, and that's flowing on to other businesses and hurting other businesses because there's not as much demand for their products. So overall the government's collecting significantly less income tax as well. A couple of other things, the budget deficit's blown out to $37.4 billion. It was expected to be about $35.1 billion in May, and now it's expected to be $35.4 billion, the size of the deficit. Economic growth is expected to be lower than predicted. So it was predicted that growth in 2015 and 2016 will be 2.5%, and next year about 2.75%. And this, again, because we're not growing at 3%, we aim to grow at 3%, is again expected to increase the size of the deficit for the same reasons. Lower income, lower company tax, as companies don't make as much money, and higher unemployment. Because if there's not the demand for our products, there'll be more unemployment. Nominal GDP is expected to fall from predicted 3.25% to 2.75%, again because of the lower commodity prices. And because the government continually running budget deficits, they have to finance these budget deficits. And to finance this deficit, so basically they're spending more than they're earning, so they've got to finance this deficit. And they do that by issuing bonds, which is kind of like an IOU to other countries. So, China might lend us money and we will give them issue with them a bond or supply them with a bond. Government debt is now around $336 billion. Okay, so these continual deficits of $37.4 billion are building up to account for a total debt of $336 billion. A couple of other things, oil prices continue to fall from $48 to $32 a barrel, and that's mainly because of increased supply from Iran, because sanctions have been removed on Iran. Iron ore and copper prices are continuing to fall, and that's mainly because of the investment phase is finished and we're supplying so much to other countries that we've got basically a surplus of iron ore and copper. And commodity prices are about 2/3 of our exports. Investment spending is falling in China. Okay, they're not spending the same amount of money in infrastructure and investment, and that's reducing the demand for our commodities because iron ore, optional E, and steel are used to build roads and build infrastructure. And the last thing is that China's devaluing its currency, which basically means that the Chinese yuan is dropped in value, which is good for them because it means their exports are more competitive, but it's bad for Australia's growth because imports from China are now cheaper, so we're buying more of them, and our exports are becoming more expensive. So that's again worsening what we call our trade balance, which we'll talk about in the next slide. February, a little bit less information. Inflation is still slow in Australia. Okay, CPI inflation's at 1.7%, sorry. And that basically means that when we we'll talk about CPI inflation next chapter, but it's basically been averaging prices in the economy are growing at about 1.7%. Petrol prices fell by 5.7% last year, which we've talked about, but the price of tobacco increased by 7.4% because of higher taxes on tobacco. So that's kind of offsetting the lower petrol prices. Underlying inflation rose by about 2%, and we'll discuss the differences between CPI inflation and underlying inflation another time. The Australian dollar dropped by 6%. So again, when the Australian dollar drops, imports become more expensive, so that can put pressure on inflation. So if businesses are using imports in production, then that will increase their cost of production. It also leads to higher demand for our exports, which could lead to higher export prices as well. So when the Australian dollar is low, other countries want our exports, and therefore export prices may go up. There's still significant excess capacity in the economy. So basically we have a weak labour market with supply outweighing demand. We have excess capital, and therefore the wage growth is very slow at the moment. So wage growth grew by 2.2% in 1990, which is the lowest since it's grown since 1997. So actual wages went up by about 2.2%, but because inflation's going up by about 2%, what it means is real wage growth is only 0.2%. So after taking into account for inflation, people's purchasing power is growing at about 0.2%, which is very slow and much slower than normally is. The good thing about low wage growth, it's bad because we have less disposable income, but it's good because it's helping to boost our international competitiveness. Businesses don't have to pay people as much money, well, they're paying only slightly more money than they have in the past, so that's helping keeping our businesses competitive. And lastly, the cash rate is still at 2%. Okay, and the good thing about a low cash rate is it keeps the dollar low, and that's helping to boost consumption and investment expenditure. People are buying houses because it's cheaper to borrow. Businesses are investing because it's cheaper for them to go into debt. And finally, we have March. Okay, so what's happening in March? Well, GDP growth is up to 3%, so GDP growth is slightly higher and getting towards our target range. And that's basically because of higher consumer spending. Okay, consumer spending and government spending are quite high, those components of aggregate demand, but business investment spending just continued to drop for the last year. Okay, it's a big demand side factor that's causing growth to slow down. Demand is down 12% for the year and 21% since its peak in 2012. Okay, and that's going to hurt our future productive capacity because we're not investing in our future as much as we have in the past. So we're not improving our technology, we're not improving our infrastructure. Mining investment is down 41% since its peak. The higher dollar in recent years has crippled manufacturing, but now the dollar is getting lower and he's improving for some industries, although manufacturing is basically dead. Wage growth is still low. Household savings is actually slightly down from past compared to other periods. So basically, households are saving a slightly lower percentage of their disposable income. And that's a sign that consumer confidence is growing a little bit in the economy. It's also a sign that house prices are increased. And when house prices increase, people feel like they're richer, so they will generally spend more. And the main reason the household savings is low is because interest rates are really low. So people are willing to take on debt, and that's leading to a reduction in their savings. Okay, and the final thing, and I'll talk about all these three together, is that Australia's trade deficit is getting really, really big. So the trade deficit is the difference between the value of our exports and our imports. And because the price of our exports is so low, we're not getting much value for our exports. So we're still selling a similar quantity, but we're selling them at a much lower price. And therefore the trade deficit is getting much, much bigger. And that's leading to a big current account deficit, again a concept we will learn more about in future weeks. Our current account deficit is now 4.6% of our GDP, and that's because we're exporting a lot less than we're importing in terms of the total value. The dollar has gone down a little bit though, so that has helped to improve net services because there's been more demand for tourism and education. And finally, because essentially Australia is spending more than we're earning, we're going into a lot more debt. So total debt for our country, not just government debt, but total debt is now over $1,000 billion and represents about 61.7% of our GDP. So basically what's happening is we keep spending more than we're earning, and therefore that's increasing our debt every single year. And the other thing is because the Australian dollar is now falling, if we have to pay countries back even more money, because our dollar's not worth as much, we have to pay them back even more, and therefore the size of our debt has just started to grow. So for example, if we owed America $600 billion when the Australian dollar was $1 American dollar, now that it's only 77 cents, we'd owe them about, say, $800 billion, which is bad. That's all. Hopefully you've read these articles as well.